So the economy's been a little crazy for a little bit now. At the start of the first year of the new decade, the economy was moving at an amazing clip. Unemployment, GDP, and the stock market were all making steady gains. And 6 months in, 40 million people are unemployed. The stock market is volatile at best. Although it's mostly recovered from the lows it experienced in February and March, the GDP and the economy are currently moving in a positive direction. But a second or third or fourth wave of COVID-19 threatens all of that, with governments already hesitant to open up their economies even further. And we're not even getting into the social and political unrest that is currently sweeping the country and to a large extent the world. You would think that would be the worst possible time to invest. Well, you'd be wrong. In this video, we're going to talk about the 5 best ways to start investing even if you have little money. Because times like these are what build true wealth. So, be sure to like and subscribe and hit that notification bell so you can get more great content when we drop it. Well, what's up you guys? You're watching BTB Fusion. I'm your host, Derek West, lead software engineer, online business enthusiast, PC gamer, and all-around good guy. On BTB Fusion, it's our mission to inspire you to take imperfect action on your business and personal finances using the power of technology. Volatile times and political circumstances are the times to begin investing. If you invest when markets are high and things are nice and calm, it's not necessarily a bad thing. You'll make steady gains, and if you play your cards right, you can retire very comfortably with a nice little nest egg. But times of volatility are times when people panic. Panicking people make irrational decisions. And if you can keep your head on straight and just follow a couple simple principles, you can profit from their rash decisions. You've probably heard of these principles before, so I'll just go over them briefly. One of them is to buy low and sell high. Don't sell your stocks, index funds, mutual funds, etc. at the bottom of a market. If you need cash for whatever reason during these hectic and volatile economic times, selling your investments when they're at the bottom is probably the worst way to get it. A little bit of patience is required to wait for your investments to return to their pre-crisis levels. And they almost always do that. Unless, of course, you're holding stocks in buggy whip companies or penny stocks or stocks in companies that are declaring bankruptcy. So just pause, take a breath, and wait a few days or weeks. Even some of the distressed industries like airlines and hotels at the beginning of this crisis had begun to recover. Now, I'm not saying that those are good investments, but if you had sold the stocks when they were at their bottoms, you would have missed the recovery. Next, don't day trade. Day traders, people trading on margin and other high-risk trading strategies like options, are typically the kinds of people who get wiped out during periods of volatility, and typically the ones that need cash to pay their loans, and therefore selling out of their stock positions to try and make their balance sheets balance. You are probably better off just holding index funds, ETFs, and maybe 4 to 5 stocks of companies that you believe in, than trading based on signals during the day. There are people that do that for a living and are very successful at it, but they're probably not you. And they're typically the top 1% of their college mathematics classes. They typically have a good sense for what to trade and when. And most everyone else will fail at this particular strategy. So just KISS, i.e. keep it simple, stupid, and just buy index funds, ETFs, REITs, things like that, and only companies that you trust and have a good sense or idea that they're going to grow. The next principle, be consistent. So that applies to a lot of things actually. Things like consistently taking money that you earn and investing into instruments that you trust. Consistently stay calm and don't get greedy in good markets. And consistently don't be fearful in bad markets. Keeping those principles in mind will help you to be successful when applying these 5 different ways to invest. And the first step would be to learn to save. Saving is the beginning of investing. If you learn to save, you're building the foundation of skills you need to learn to invest. Learning to save builds the discipline to put your money away and delay gratification. Learning to invest is about putting that money in a place where it will grow and not shrink, like in a savings account that doesn't pay the rate of inflation. I've talked a little bit about saving before on this channel and ways to do it. A popular way is the bucket method. A lot of people have different names for the same concept, and several apps out there apply different meta principles to this method. Some folks call it the envelope method. Some people think of it as the jar method. Some people call it the color of money. But the principle is the same for all methods. You take the money that you earn, whether it's from your job or your billion-dollar drop shipping side hustle, and you drop it into buckets, envelopes, whatever, that you then use for your expenses. For example, and sticking with the bucket metaphor, you would have a bucket for housing expenses, a bucket for food, a bucket for travel, a bucket for Lambo waxings, whatever is important to you. You would of course specify buckets for needs first, and then you would have buckets for high priority wants. And the most important need would be your savings. If you've never been a saver before, then you can start out small. Maybe taking the change from purchases you've made over the day and putting it in said bucket, or jar, or envelope, or whatever. Then maybe going up to $10 per week, and then start building and building. Ideally, you'll want to get to the place where you're saving over half of your monthly earnings. And once you're at that position, you'll want to save 6 months to a year's worth of your needs-based expenses. That is food, housing, shelter, things like that. And to do this, you'll have to make sure you maximize your first flow, whatever that is, whether that is earnings from your main job, or if you're a business owner, maximizing your earnings from that. The second way to invest, even if you have a little money, is to invest in yourself. The greatest investment return you will get is when you invest in improving yourself. This could be about improving your education by spending time watching videos on things like investment and technology and personal finance. Like and subscribe. Or even a bit more formal, with actual classes and getting certified in your professional field. People typically think of college when they think of things like that, but that's not necessarily the only way to invest in your education. There are online courses that can teach you just about anything from various sites. Places like Pluralsight, Udemy, Skillshare, etc. They're literally all over the place. It could even include investing in your health. After all, health is wealth. In other words, start to consume higher quality foods, get a gym membership, or buy exercise equipment to work out from your home. But specifically for your investments, if you invest in your education to improve your marketing skills, you will most certainly improve your ability to earn money. Improving your ability to earn money will improve your ability to save money. Remember the first point, which will improve your ability to invest money. See how that works? It's a cycle, a good cycle, like a buy cycle. Next up, Robo Invest for success. Remember when I talked about keeping your head on your shoulders and not panicking when the markets are volatile? Well, unfortunately, that's not easy for human beings to do. You see, human beings have these things called emotions, and emotions make it hard for us to make rational decisions. Anybody that's left a long series of text messages to their ex-girlfriend knows exactly that feeling. Well, thankfully, the age of the robo-investor is upon us. Robo-investors work by asking a few simple questions to determine your goals and risk tolerances, and then invest your money in highly diversified low-cost portfolios of stocks and bonds. Robo-advisors then use algorithms to continually rebalance your portfolio and optimize it for taxes. Really, there isn't an easier way to get started in long-term investing. Most robo-advisors require just $500 or less to start investing and charge very modest fees based upon the size of your account. All offer automated investing plans to help grow your balance. Now, there's a downside to everything, and there's a downside to robo-investing too. Robo-advisors cost money. Robo-advisors charge an annual fee equal to a small percentage of your balance. The industry average is about 0.25%, so if you invest $10,000, you'll pay $25 a year. Now that's not a ton of money, but it begins to add up if you amass hundreds of thousands of dollars. For example, if you have $1 million in your account, after the end of a year, you'll pay $2,500 for that year. Still, not a ton of money in the grand scheme of things, but it is money. And you need to understand that it's fees on top of the fees charged by the exchange-traded funds that robo-advisors buy to make up your portfolio. You can avoid paying the robo-advisor fees by building your own portfolio of ETFs or mutual funds, but for the vast majority of investors, that's a lot of additional work and responsibility. As I'm sure you know, there are a ton of robo-investors out there already, from Wealthfront, M1 Finance to Betterment, and there are more and more coming online. Robo-investors are not the cure-all for your investment needs, but they definitely make it real easy to begin to invest. Invest in real estate. The easy way. Believe it or not, you no longer need a lot of money or even good credit to invest in real estate. A new category of investment known as real estate crowdfunding makes it possible to own fractional shares of large commercial properties without the headache of being a landlord. Crowdfunded real estate investments require larger minimum investments than, let's say, your average Robo investor. For example, $5,000 instead of $500. They're also riskier investments because you're putting that entire $5,000 into one property rather than a diversified portfolio of hundreds of individual investments. The upside is owning a piece of a real physical asset that's not necessarily correlated with the stock market, but it is correlated with the real estate market, which, as we know, can be volatile. But with robo-advisors, investing in real estate via a crowdfunding platform carries costs that you wouldn't pay if you bought a building yourself. But the advantages of this method are obvious. You share the costs and risks with other investors, and you have no responsibility for maintaining the property or even doing the paperwork to buy it. Which, if we're being honest, is probably the worst part about buying real estate, is all the freaking paperwork that is involved. Investing in mutual funds. Mutual funds are investment securities that allow you to invest in a portfolio of stocks and bonds with a single transaction, making them perfect for new investors. The trouble is, many mutual fund companies require initial minimum investments of anywhere between $500 and $5,000. If you're a first-time investor with little money to invest, those minimums can be out of reach. But some mutual fund companies will waive the account minimums if you agree to automatic monthly investments of between $500 and $100. Mutual fund companies that have been known to do this include Dreyfus, Transamerica, and T. Rowe Price. An automatic investing arrangement is particularly convenient if you can do it through payroll savings. You can typically set up an automatic deposit situation through your payroll in much the same way that you do with an employer-sponsored retirement plan. Just be sure to ask whomever your human resources person is how to set it up. Speaking of setting stuff up, set yourself up for success in business, technology, and personal finance by subscribing to this YouTube channel and also clicking that notification bell and liking this video. Be sure to drop us a comment as well with what you think of these 5 different ways to begin to invest even if you have little money. Are you investing in yourself right now? Are you learning to save? Are you investing in mutual funds? What about crowdfunded real estate? Let us know down below because we're dying to know. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. Be sure to take action on your business and personal finances using the power of technology. And we'll catch you next time. Peace.